Hey everyone, welcome to goldsilverpros.com. This is Robert Keens, your host, and today I have a very special guest, the Austrolib, Rafi Farber, who's hailing from the Golan Heights in Israel. He's a self-educated student of Austrian economics, trader, a libertarian thinker, and a writer. You can find his work at both calvinire.com and Seeking Alpha. Rafi, how are you today?
I'm great. How are you?
Doing very well. Thank you so much for coming on. I've been reading a lot of what you write, both at Calvinire and at Seeking Alpha. You have a very, I think, unique viewpoint on the markets, I think, resulting from your experience as a trader and also as an Austrian School of Economics scholar, which seems to be the exception rather than the norm in these days. Would you mind just giving a little bit of background on how you came about to become a trader and what your thoughts are on Austrian School of Economics?
Well, you can either start in 2012 or long before that. But I'll start just a little anecdote from a long time before 2012, was when I really got into this, thanks to Ron Paul. But I remember talking to my father as this stuff was breaking, as you know, COVID was becoming a serious thing. And when I first heard about it, I just wrote it off. I was like, oh, whatever. It's another one of those, Armageddon type crazy things that people are just going to take out of, it's just going to pass, but people took away out of proportion. I didn't think it was a big thing, but apparently it is. So I remember talking to my father when it became obvious that this was going to be a big thing, and saying, Abba, which is Hebrew for father, Abba, you gotta get some silver now. You have to protect yourself. And then I told him, I remember when I was a kid and I was trying to understand why prices kept going up. This is in the early 90s. 8, 9, 10 years old, something like that. And I already noticed that the prices of everything always rose. And I asked him why. And he said, oh, well, inflation, that's how you grow an economy. That's how it works. And I remember thinking as a kid, it doesn't really make much sense. How can that keep going? Because if prices always go up, then eventually everything's going to be like $1 million. By the time I'm 70, 80 years old, is this ever going to stop? What's going to happen? So then I kind of just wrote it off. I was like, well, my father's saying that and he knows more than me. So I just, whatever. Okay. But then those questions started getting more serious like this. And I started seeing what was happening, more and more economic activity, more and more central planning. I heard more about Alan Greenspan, and then 2008 happened. I still wasn't really conscious of what was going on so much, but I had thought back to those moments when I was a kid and saying that prices are always supposed to rise, and all of a sudden they're falling, and I'm like, this whole system doesn't make any sense. So then, I don't know, I became like a political atheist. I suddenly realized that everyone was lying, and I stopped voting, stopped caring about it. But then in 2012, I ran into Ron Paul, and he was saying, completely different things. Every little suspicion that I had, since I was 8 years old, talking about it and saying this doesn't work. So I got really into Ron Paul. I started respecting, at least one politician again. And from there, he introduced me to the Austrian School of Economics and that way of thinking. And it all made sense. And especially the fact that, I live in Israel, and unlike most American Israelis, I really don't appreciate American involvement here, and I don't want any of their foreign aid, and I just want them to leave us alone and be like regular allies and be friendly and just stay out of our business. And I would also like Netanyahu to stay out of America's business as well. So the fact that Ron Paul was, a non-interventionist was a big turn on to me, and I got really into it. And from there, I started reading, Mises and Rothbard, mainly then those two, and some Hazlitt. And I wouldn't call myself an Austrian economics scholar or anything. I don't have a degree in it. I'm not an academic. I don't speak that language. I have a relationship with some Austrian economists, particularly Walter Block, who I wrote the foreword to his book on Ron Paul. So I'm familiar with the lingo. I'm familiar with the basic literature. But I'm not a doctorate or anything, so I'm not going to get into the terminology and the nitpicking, hair splitting definitions or anything like that. Just the basic concept.
Yeah. So it's just real world experience with the political system and the financial system that kind of led you down that path. And one of the things that you talk a lot about, you write a lot about Seeking Alpha is gold. So I wanted to spend a few moments on that. You recently wrote that gold's going to new records, and you're writing something about the open interest on COMEX. Can you explain that relationship?
Not exactly, but I can try.
Okay.
Um, so open interest are the amount of gold contracts that are to be settled on the commodity exchange in Chicago and New York.
Mm-hmm.
So what tends to, the way futures are designed to work, the reason that they exist is that if you have a company that mines gold and then they want to lock in a sales price before they actually dig it up from the ground and have it available, they want to make sure that they're going to lock in a price. So they sell a contract. Okay, I'm gonna dig up 100 ounces of gold in 6 months from now, and 6 months from now you can buy it at this price. So they sell the contract.
Mm-hmm.
So we call that shorting. Technically, it's called selling short. It's not really selling short if you're a commercial company, because they're expecting to produce the gold. They just want to know what their income is going to be 6 months from now, and they sell the contract. So that's the purpose of futures. Now, and then what happened was banks who don't have gold, or some banks have gold, but let's say they don't, because not all banks do. Let's say a bank doesn't have gold, or a speculator of any kind doesn't have any gold, and he wants to speculate on the price of gold, not having any to back it up. So he sells a contract, and that's a bona fide short because he has no gold to hand over when the contract expires. So if somebody demands delivery on that gold and he doesn't have it, he's going to have to go into the market and buy it. Right? And that's going to push the price up. Whereas a commercial, let's say Barrick Gold or Newmont or something, if they sell a contract and then they have the gold to deliver, they don't have to buy the gold. They have it. They mined it. It takes time, but they can do it. So what's happening on the COMEX is all these speculators figured out, and this has been going on for decades, that if you sell a contract in gold, you can keep selling them until there are so many contracts that the price of gold eventually falls because of the plethora abundance of contracts. And then when the price falls, you cover and you make a profit. And if you don't make a profit on that contract, you roll over, you keep going. Sometimes you lose some, but usually you make money, because if you issue enough contracts, the price will fall. Now, what seems to be happening now is that people are becoming traders who are going into the futures market are becoming increasingly wary of the amount of dollars that are in the system, and some of them are demanding delivery. Now, to get delivery, speculators are going to have to buy, and if that happens, the price is going to go up, and then they get caught in their shorts. So I can't tell you exactly who is caught where, but I would recommend that if you want more information on this in terms of the mechanics of what's going on, then you should read Alistair McLeod at goldmoney.com, who seems to have the best grasp on this that I've seen.
Yeah, but I agree. I read his stuff all the time, and he seems to understand the mechanics better than most.
Yeah. I get the basic idea, and I trust it because I see what's going on in the broad picture of things. Like the economy is a massive moving machine where no one can master every part. You can have a good sense of the overview, which is what I think I have, and then you can have someone who's better at the inner mechanics of some part of the machinery, which other people have, and you want to go and kind of combine your knowledge of with different angles, try to get a better picture of things, and use your intuition on who's BSing and who's not.
Yeah. You recently also wrote in a different article that you think gold stocks are better investments than the gold ETFs, and I assume you meant like the GLD and like type of investments. Can you explain why you feel that way?
Well, that there's a lot of caveats in that statement. It depends what you mean by investment. So if you're using them for trading, all right, then like for short-term stuff, and maybe a month or two, then you could say that maybe gold ETFs are better because they're more stable, and if you're looking for like capital preservation or something short-term, depends what you want to do. If you're in it for the end game, right? For you believe that the dollar is going to fall, that it's going to collapse, that it's not going to be used as an intermediary to gold anymore. By the way, I don't see the dollar as money. I see it as a gold intermediary, which is what it's been since 1970, since it's existed, even when we're on a gold standard. So the way that I was saying that gold stocks are safer than gold ETFs is that if the dollar does collapse to nothing, then what's your GLD or what's your IAU, any of these ETFs, what's it going to be worth?
Mm-hmm.
What ticker are you going to see on Yahoo Finance or whatever site you use to look at the prices of your ETFs? Is it going to be $1 billion, $1 trillion? What is that going to matter if the dollar isn't worth anything? And you can't get the gold to deliver. On the other hand, if you own gold stocks like Barrick, Newmont, or whatever gold company, then even if the price of that gold stock is undefined because the dollar doesn't buy anything anymore, you still own a real title to a real piece of capital that exists, right? If you own GLD, you own a piece of a trust that will never deliver your gold because you're not an institutional investor, or you're not a broker dealer, and so what do you got? You got nothing. But even if the price doesn't exist, you still have a real piece of capital in a gold mining company that can pay you real dividends somehow. Once the mess is sorted out, you still own the title. So in that sense, they're safer than ETFs.
Do you follow stocks specifically, or are there any that you like to follow, or you just look at the indexes?
There are certain gold mining companies that I own, certain ones that I like better than others, but I can't say that I'm a mining expert and I understand geology or anything like that. I basically look at jurisdiction, where they are, their balance sheet, and maybe some of the mines that they have and where those are. You have the jurisdiction of where the gold mining company is headquartered. That's important because then they're subject to that government. You also need to look at the mines that they have and what countries they're in to see if they're stable or not, or if they could get nationalized or something. But usually it's just balance sheet and jurisdiction is my biggest concern.
Okay. Given some of the shortages we have in the physical gold market now, some of it stemming from COVID, supply chain closings, but also I think just the incredible demand we have. You mentioned an alternative to physical gold investment, maybe owning the Perth Mint physical gold ETF. Why is that potentially a good investment?
Yeah. So the best ETF, if you can't get your hands on physical right now, I would say is AAAU, the Perth Mint ETF. I say that first because, again, jurisdiction. It's in Australia. It's not subject to, the federal government or anything like that. And it seems, though I've never actually tested this, it seems that you can get delivered your gold at any threshold. And the Perth Mint works with people who I trust, like Peter Schiff. Schiff Gold gets a lot of its supply from the Perth Mint. So they're generally trustworthy. Is it 100% that they're going to deliver everything on time and everything? I don't know 100%. But if I had to pick an ETF, if I really wanted physical gold in the event that the dollar really crashed, I would pick the Perth Mint ETF. Yeah.
You recently wrote an article on CalvinIR.com talking about China, U.S., and Macau, and I wanted to get your thoughts on the relationship between China and the U.S. from a trade perspective. What are your thoughts there, and do you think that they're going to be able to resolve their trade dispute, or what do you see coming next?
Well, you have to. I don't know exactly what's coming next. It depends if we are at the end game or not, and I think we are, but I could be wrong. I mean, I spoke about this with my wife a few weeks ago when this was starting, and I was telling my wife, like, this has to be it. I mean, how can they reflate it after this? It just doesn't seem possible. And then, she tells me, okay, Rafi, but in case they can, just up the order of magnitude again from, maybe from billions to trillions, we're just going to change, the numbers that we say. They're just going to print trillions, and the next time it's going to be quadrillions. And I have to know that you're still going to be here on Earth and not despairing. But yeah, so the trade, this whole inflationary cycle that we have, it's centered on the U.S. and China, because the U.S. prints the world's reserve currency, right? So basically, our main product of export is inflation, which means money. And the Chinese, they got caught in Keynesian economics also. So they think, this old mercantilist thinking from the 18th century that you have to export more than you import and just collect currency that you're never going to use. It's a ludicrous idea, but that's what they believe, seemingly, because of Keynesian influence all over the world. So they've stacked all these treasuries in the People's Bank of China, and there's no way out of it. But since I don't want to say we, I don't live there anymore, but since Americans export inflation, that gives them a twin deficit of a trade imbalance and a fiscal imbalance. They come together. So then Americans become dependent on all these imports from China that are cheap because they keep printing money, and the whole thing, it cannot continue. So this is not some little trade dispute. It's an entire system that has to collapse. And eventually China is going to have to stop collecting all these treasuries that they're putting in their basement that are never going to be paid. So one day, I don't know what day, maybe this year, maybe sometime next year, but sometime soon, all those treasuries in China are going to come out of their basement and into the market. And that is when the bond treasury market really collapses. And then Americans cannot afford anymore to import goods from China. They will have to make it themselves. But in order for that to happen, you have to completely restructure the economy. You have to get rid of a whole bunch of regulations, make everything a lot cheaper. You got to go back on a gold standard, which forces the balance in trade. As long as you can keep printing money, you can keep having imbalanced trade, which means imbalanced deficits, and they all go together. So the entire relationship between the U.S. and China in trade has to change from the foundation, and that is going to be painful for both countries.
Yeah. You also recently wrote about hyperinflation experience in Israel and what happened to the shekel. Can you explain a little bit about that experience and how did that affect your view on economics in general?
Well, I can't say that affected me directly because I was born in 1983. So this happened in 1984, 1985. I was 1 and 2. I was not aware of inflation, but it was on my mind. When I was asking questions to my father about inflation, and he told me about that. Because he in his desk, I remember he had this bill with Maimonides on it, the Rambam, Jewish scholar in the 12th century, and it said 1,000 shekels on it. I was like, but you have 1,000 shekels? And I'm like, yeah, well, it's from an old currency that doesn't exist anymore. So now it's the new shekel. I didn't know it was called the new shekel. So in the 1980s, what was happening was it really started in 1970. 1970, the 70s were a tough decade for all Western economies, Israel included. And we had the Yom Kippur War where, we almost got invaded by Egypt and killed. And then, the 1973, the oil embargo. And then by 1979, 1980, when inflation was really picking up in the U.S., you guys had Paul Volcker and the late Paul Volcker, it's almost, a blessing for him that he passed away recently because he doesn't have to see all of, the dollar that he saved die completely. At least he won't be here to see that. Not that Paul Volcker is my hero or anything, but he was the least bad Fed chairman recently. So by 1980, 1981, as inflation was picking up in the U.S., it was also picking up here in Israel. So the Fed chairman, I'm not sure if it was him or one of his colleagues on the Federal Reserve Board, said, prices are picking up. We have to print more money so people have enough money to buy things. But that's what causes hyperinflation. So that's the path that the Bank of Israel took. They said, prices are rising. How do we solve that? We got to print money so people have enough money to buy things. And that's what caused the hyperinflation, and the old shekel died. When the old shekel died, all debts were wiped out, and they introduced the new shekel with a change, and that the Bank of Israel could no longer directly finance the government deficits. The Fed doesn't directly finance the government deficit. It's getting closer and closer to that. They don't just hand money. They buy bonds in the secondary market. But right now in the UK, in the United Kingdom, for example, the Bank of England is directly financing government deficits. And the Fed is really close to that. They buy on the secondary market. Maybe a primary dealer holds the paper for a week or something, and they buy it a week later. But that's really close. So anyway, the new shekel was introduced. The Bank of Israel was not allowed to directly finance anymore, and prices were indexed to dollar prices, and you're able to restart an economy by then. As long as you have a reference point for what free market prices sort of are, you can apportion goods and services generally okay, even if you don't have a money of your own, just like the Soviet Union did. How did the Soviet Union distribute goods and services at all? At all of it, They referenced loosely dollar prices across the ocean.
Mm-hmm.
It wasn't that good, but at least people got something.
Sure. Some way to value the good and some sort
Yeah.
of currency. Yeah. Interesting. You mentioned the British pound, because I think you also wrote recently that the Bank of England is directly financing the government's COVID-19 spending. Do you think that the pound could go into hyperinflation if this continues?
Yeah. Well, we have to stop talking about individual currencies, except we can isolate maybe the ruble.
Mm-hmm.
But the way that the currency system works
Mm-hmm.
is that everything is based on the dollar, which in the past was based on gold. If you go by Ludwig von Mises's regression theorem, that's why the dollar has value, because gold has value.
Mm-hmm.
But since all currencies, almost all of them, are backed in their central banks by a reserve of dollars, that's what it literally means, the reserve currency of the world, that every central bank that has a fiat currency, left over from the Bretton Woods Agreement, where the U.S. promised to, they said, look, you don't have to hold gold anymore, Mr. Central Bank of England or Switzerland or whatever.
Mm-hmm.
You don't have to hold gold anymore. We'll hold your gold at the Fed. You just hold dollars, and we'll pay you gold for the dollars. And that didn't work because they printed too much dollars and they ran out of gold. So they defaulted on that. But now it's left. The system we have now is sort of like, it's the ghost of the Bretton Woods system, because everyone still has their reserve dollars that they had when they bought dollars under Bretton Woods, and it's still there. So every fiat currency now is still backed by dollar paper. So when the dollar collapses, the backing to those currencies all go to zero. So when the dollar falls, all fiat currencies fall, except for currencies where central banks have a substantial backing of gold, and the only one I know of for sure is Russia.
Mm. You wrote recently you think the U.S. may have to print $100 trillion in currency, and it had to do with gross output and GDP. Can you explain that?
Okay, I don't remember all the math that I wrote about it. I have to look at the article again. But basically, how I calculated that was I looked at the collapse in GDP in the 2008 crisis, and then the collapse in gross output. Gross output is GDP is the final product that is produced and that is bought, and that's counted as gross domestic product, final goods and services. So gross output, before you get to a final product, you have to produce it, you have to build things, or even if it's a service, you have to pass on the work or the software, whatever it is that you're selling. And every payment that happens down the chain of production is included in gross output. Now, gross output is always going to be higher than GDP because there's more payments made up to a final product than the final product itself. So I found that gross output is about on average 1.77 times GDP. So I think it was JP Morgan who said that Q2 GDP would fall by 40% relative to Q2 2019. I said, okay, so 40%, let's call that X. So gross output would be 1.77x of, however many $trillion that is in decline. And then I looked at the amount of money that was added to the balance sheet of the Fed in the 2008 crisis. And then relative to the amount that gross output fell. And then looked at the amount that gross output should fall if JP Morgan is right. And then just, did a comparison. So if they printed that much money back in 2008 when gross output fell, however much it was, 3-4 trillion, I don't remember. So now it's going to be about 7 times that. So 7 times that, that's going to be the monetary base that you add to that is added to the balance sheet. This is base money. This is not money supply. Money supply is all money. That includes base money that's held in every bank account. So the money supply would have to increase to about $100 trillion, give or take. It could be 80 trillion, it could be 100 trillion, 120 trillion, but look, by then it doesn't matter. Because when people lose confidence in the money, it doesn't matter what the supply is, people don't want it.
Yeah, I wrote in 2018 about the coming dollar shortage, and a lot of it had to do with, I took it from the perspective of looking at the debt. You had trillions in debt outstanding internationally that was US dollar denominated, plus you had, of course, a ton here. The corporates have it. So there were just trillions and trillions of debt, and then there's about 1.8 at the time trillion liquid dollars. A lot of them held on bank balance sheets or in bank accounts, so it all wasn't sloshing around the economy. But what happened when we had that correction in the market in 2018? It caused a little bit of a panic in what we now know led to the repo panic in September of 2019. So a lot of factors went in there. JP Morgan, using a lot of the money that they had put into liquidity of the money markets had moved that over to other investments. They made a big bet on U.S. Treasuries. But, there's not enough liquid money in the system to service the debt, essentially. And that's what led to the repo market crisis. And I think that's what's leading to all these swap lines that the U.S. central bank is opening with all these other banks. There's all this debt, but there's not enough cash. And they need much more cash to service this debt. And I think with the COVID-19 crisis, that's actually exacerbating what we previously saw in the repo market. And it's put it on a completely different scale. So it's interesting that you looked at it from a gross output GDP perspective and came up with 100 trillion. That's a pretty interesting number. Wanted to switch over to gaming for a moment. I know you write for CalvinIR.com and you cover the gaming and gambling markets. I know nothing about these markets, but I wanted to ask you, how has COVID-19 affected these? Has it really affected these markets a lot, or are they closing the casinos, or what's happening?
Oh yeah, it has. It's interesting. For companies like MGM that operate mostly in Las Vegas, everything is closed. Like, everything is closed. Macau is recovering a little bit now because they've opened up. They were the first ones to get hit. Now the first ones to reopen. You have some interesting cases in let's say Cambodia, right? Which is a monopoly of the Cambodian government. It's not like they went from Pol Pot to monopolizing the gaming market, which is a little better. But for example, in Cambodia, you had people that were going to go, these really, really rich Chinese people, that they wanted to gamble in Macau, but they couldn't. So they went to Nagacorp in Cambodia, and Nagacorp's numbers were inflated for the last few months because they couldn't go to Macau. So you have some of that situation, but the other thing you're seeing is that there's more online gambling now. People are stuck in their houses and they're bored, so they're playing poker, they're playing online games or whatever it is. They're gambling their money, and this is, I think, a big mistake is to see this as a bullish sign for the gaming industry, because it's not. It's basically people using their cash reserves because they're bored and they don't have anything else to do. But eventually that's going, when people run out of money, that's going to fall away also. So yeah, there was, well, one little interesting story. In 2008, the end of 2008, Caesars was acquired by Apollo, which is a big fund. And it was a leveraged buyout of a very, very indebted casino, right just before the financial crisis, and that totally went under. Now Caesars is still alive because they had a huge bankruptcy. They were like $23 billion in debt. And what they did was they stuffed all their bad assets into a shell, a worthless shell, and so that it protected it. And they took all their good assets and they put it into a different company, so that the equity holders were stuck with the garbage and they could pay off their bondholders. Not go. It was a big mess, and it was very immoral. But what happened this time? It's like very, very similar. And Carl Icahn, who was I wouldn't say one of my idols, but I respect him a lot. But he owned a chunk of Caesars, and or was it El Dorado? He owns one of them. He was either El Dorado or Caesars, and he was behind a leveraged buyout of Caesars. Again, the same company that went bankrupt, from the 2008 financial crisis, to be bought out by a tiny company called El Dorado. And El Dorado bought, I think, for $17 billion just before the COVID crisis. And I wrote several articles about this, warning Carl Icahn, like, don't do this. I don't know exactly what's going to happen, but this whole thing is going to collapse very soon. Something. This is before there was any COVID-19, and it did. And El Dorado went down from like $74 a share to something like $6 at the low, or some crazy number like that. They've bounced back a little bit, but I think the whole deal is going to fall apart again. And it's the same thing again. Yeah. People just go into these humongous leverage buyouts right before a crisis, And yeah, the gambling industry has been really schmeiced. It's been really bad.
One thing I'm keeping an eye on is how the losers in a lot of these industries because of COVID-19. So you look at a lot of small business in the United States, and you're going to look at a lot of restaurant chains, for example, places like that are going to go bankrupt. How is that going to affect the overall debt market? Is that going to, prick the bubble of the debt market? Is that going to cause a bigger chain reaction in the economy to where we're looking at potentially a big bank default, Bank of America, Deutsche Bank, something like that, that sort of cascades through the system? That's something I'm looking for. I hope, definitely not hoping it happens, but you never know what's going to be the catalyst. Could COVID-19 be the black swan, that has pricked this debt bubble, or will it just be a contributor? We really don't know. But I know if you had any thoughts on that or what you see next for the global debt markets.
Well, you have to look at the balance sheet of all the central banks in the world.
Mm.
And if you look at them, I mean, everything is going so fast now.
Mm.
They're buying up so much debt, junk debt, that really the debt markets have already imploded. I mean, if you look at, I wrote an article on Seeking Alpha maybe last July on a CLO fund. It's a collateralized loan obligation fund called Oxford Lane Capital or something.
Mm-hmm.
And they yield like some crazy number, like 30%. If you ever seen The Big Short, they describe what collateralized loan obligations are there. Just being like debt, like packaged into big bundles. And this was I was warning on Seeking Alpha, like, if anything happens, this fund is going to tank and they're going to stop paying dividends. So that's exactly what happened. I mean, it went from like, I think it was like $10 to like $1, and then they stopped paying everything. Recently, their last press release was like, we're not paying any more dividends because of this COVID-19. So my point is, you're seeing junk debt already falling at the edges. So what I see happening is that the really bad debt, the debt that should never have been bought or should never have been issued, but since interest rates are so low, everyone's looking for yield, so their only option is bad debt, and this is the debt that falls first. But then the Fed starts buying that, but then the starts imploding from the bad quality debt to the good quality debt, and the last debt to fall will probably be the Treasury market. So you're gonna see bankruptcies, you're gonna see all this, but the problem really, it's bigger. The problem is not bankruptcy. Bankruptcy is the cure to this. We need to see mass bankruptcies because the entire monetary system is out of whack. What's the danger is that they're going to prevent bankruptcies, that we have to restructure the economy, and that takes a lot of pain. And everyone's looking for a solution that is the least painful, but it doesn't exist. You're either going to have mass bankruptcies or you're going to have hyperinflation. It is one or the other. There is no other way out. So, whatever happens on the fringes, the biggest danger is that if they don't allow bankruptcy, and let's talk about the biggest one, the biggest bankruptcy, which would be the federal government itself. At some point, the federal government is going to have a choice, or the Fed is going to have a choice. Are they going to keep interest rates low nominally so that the interest on the debt can be paid, even when nobody else is buying treasuries and the only one buying them is the Federal Reserve? In that case, then the dollar goes to zero and all the debt becomes deflated in gold terms, right? So the big danger is not bankruptcy. Let it happen. It's going to happen. The big danger is that if they want the bankruptcies to nominally not happen, they will happen in real terms, then everyone's monetary medium is going to die. And that's the real danger.
Yeah. Thank you so much, Rafi. I appreciate the conversation. I wish we had more time, but definitely thank you so much for your time. And I think we should touch base again in the future.
Definitely. Really fun.
All right.